Okay. Good afternoon. First, I want to just quickly apologize for the slight delay. We're waiting till some of the other participants also join us. So, first of all, a warm welcome to all of you who are joining our investor webinar for the first quarter, where NDB is reviewing the first quarter results. Going by the presentation, moving forward. Okay, moving to the page 1. This one, no? Yeah, this is actually the group structure with NDB and also the NDB group companies. So this webinar covers mainly the bank performance, but of course the group contribution is also covered in that. Moving forward, overall business overview. In fact, yesterday we opened a 106th branch at Kottawa. So now we have 106 branches and of course 118 ATMs and internet banking access points as well. The one key area that I want to highlight is the NDB mobile banking app, which has been quite a success. I thought of sharing with investors that the first 4 months, over 1 billion kind of transactions were routed through our NDB mobile app. For 4 months for a mobile app, I think that's one of the key drivers. And also in the process, Global Banking and Finance Review also has recognized our mobile app as the best mobile app in Sri Lanka. We'll share some more details later on during the presentation. Yeah, these are about some of the awards that we won during the actually soon after the first quarter, in fact in April and May. Global Banking and Finance has awarded mobile app as the best mobile bank application, and also we are rated as best SME bank for 2017, and this is actually in line with our strategy, also moving towards more SME retail driven strategy, and also for the best investor relations bank. And I'm sure the webinars like this on quarterly basis and also the press conferences that we had earlier helps us to maintain this momentum as the most investor friendly bank in Sri Lanka. Then in addition to these 3 awards, CMO Gold and Globe Brand Excellence Awards in Malaysia, we were recognized, one for the Brand Excellence within the banking and finance sector 2017, and also the award for Excellence in Social Media Marketing. Plus our NDB Group Investment Banking Cluster, the Global Brands Magazine recognized as Most Trusted Investment Banking Brand in Sri Lanka, and also Asia Money Banking Awards. During that, our investment banking arm was recognized as Most Trusted Investment Banking Brand in Sri Lanka. So these are some of the recognitions and awards, and we are quite pleased with the progress. And we thought that we should share that also with the investor community. Very quickly on macroeconomic and industry analysis. During the quarter, the global economy, we saw some of the global economic activities picking up. And this was something long awaited, a cyclical recovery that we are seeing in investments, manufacturing and trade side. World growth is expected to rise from 3.1% last year to around 3.5%. Talking about Sri Lankan economy, after a trend in inflation, that's something that we noted in March. CCPI core inflation moved up to 7.3% in March. However, in April, this trend was reversed. Rupee also saw a slight depreciation during January to April period. And also the market trade saw some increase in the WPLR moving up in first quarter. Probably on the rupee dollar side, either today's conclusion of Sri Lanka's issuance of the bonds up to 1.5 billion, which is around 6.25%. And with the appeal, when the book building process, what I understand is over 11 billion worth of investment appetite was shown, which is actually quite a good reflection of country's standing and also the appetite for bonds, so which is augur well for the Sri Lanka going forward. Banking sector, talk about the banking sector and also the monetary board, of course, increased the standard deposit rates by 25 basis points up to 7.25 and lending rate up to 8.75. So 25% basis point increase was made during latter part of March. And also banking sector total assets, as per the central bank numbers, have grown by around 13.5% in the first quarter. Moving on to the bank's performance, but prior to that, I thought that I should explain the unlocking the true potential and unleash yours. This was the theme that we basically launched when we issued our annual report. NDB as a group has huge potential, and what we are trying to do is unlocking that potential, not only the bank, the various group companies, and unlock those potentials. So through that, unleash our customers' potential. So that was our tagline. So that's basically, I thought that we should share a bit about that as well. Moving towards our numbers, these are performance summary. The quarter had a very, very good growth in terms of net operating income. We are comparing quarter one last year against this quarter, 28% growth from 2.8 billion to 3.6 billion. Operating expenses, of course, it grew, but it was quite a controlled growth in terms of its 10% growth from 1.5 billion to 1.7. A couple of things actually contributed to though we're trying to manage our cost down. One major contributor factor was the deposit insurance premium. You would note that we had a significant growth in deposits later on. You will see that in the balance sheet, plus the VAT increases and all. So that's why the operating expenses growth was around 10%. But still, compared to the operating income growth of 28%, it's quite managed well. So after-tax profit, actually that's where 45% growth in after-tax profit from 797 million last year to 1.1 billion first quarter. In terms of balance sheet growth, we compare with the year-end balance sheet so that it's a 3 months progress. Total assets have grown by 4%. Total loans, 6% growth. In terms of the quantum, it's roughly 13 billion for 3 months. As the biggest growth came in deposits, 24 billion growth, and it is 12% growth for a quarter, quite a sizable growth. And I'm happy that in that growth, there's a sizable growth in CASA, we had a net growth of about 3 billion in CASA within that 24 billion. In terms of efficiency, cost income has improved significantly from 49% last year to 46%. Net interest margin, that's again an area that we were focusing quite hard in repricing and also improving our cost of fund base down. So CASA also contributed, but the repricing of the book assets and also moving towards certain asset classes, that is reflected in improvement in the NIM from 2.64% to 2.78%. So that's, though it's about 14 basis point margin in NIM, that's roughly about 5% increase in NIM. For 3 months, I believe that it's a sizable increase, and that's an area that we continue to focus going forward. Return on equity, it improved from 13.3% last year to almost 14%, 13.96%. On the balance sheet again, the loan to deposit ratio, this is a ratio that we were concentrating building up, has improved from 115% to 108%. You may recall at the last update, we are saying about our focus in growing self-funding our advanced book. So that's one of the key priorities that we are working towards. So that has been shown. One is the 24 billion growth in deposits. Other one is the improvement in AD ratio from 115 to 108%. Capital adequacy, that 12.95 last December, it has moved on to 12.76%. Still well above the requirements, minimum requirements, but this is an area that we are also working on, especially towards the second half in improving our capital base. Liquidity ratio wise, we are well above the minimum liquidity of 20%. In fact, liquidity has improved from 21.5% to 22%. Talking about the income statement, more detailed breakup. Net interest income had 355 million growth in quarter to quarter, 18% to 2.3 billion. Other income, marginal growth, 1.4 billion to 1.431 billion, roughly 2% growth. This is again quarter to quarter. Of course, the last year, in first quarter, we had some high commission income due to some of the large corporate deals that we have done last year. But without those significant deals, we have actually slightly improved. But as the overall, the core income, the fee income, that's an area that we are focusing on. We have seen some good progress. Impairments, that's where one of the good improvement is compared to 537 million impairment first quarter last year. This is 134 million impairment charge. There again, some of the unusual high impairment charges were made last year for some few accounts, which was not seen in this year. Those impairments were made on a prudency basis. Operating expenses, as we discussed earlier, 10% increase from 1.5 to 1.7. And the biggest improvement is in operating profits. As you would see, 50% growth in operating profits prior to tax from 1.2 billion to 1.9 billion. Of course, tax component 481 to 753 million. So profit after tax, there again, 45% growth from 797 million to 1.1 billion. Moving on to revenue analysis, some more detailed analysis on revenue. The net interest income, you would see a 1.9 billion to 2.3 billion. The fee income, it's around 3% improvement. Now this is where, as I mentioned, the last year the fee income 539 included some other one-off large income that we received for some of the corporate deals. So without those, we managed to have a 3% increase in fee-based income. And other income from 864 to 877. So the component of the base of income, what it shows is the core banking operations have contributed to our performance. So that's one of the key highlights from this slide. Talking about operational expenses, overall 10% growth in operational expenses. There again, the breakup is mainly personal expenses, 7% quarter-to-quarter increase. That's in line with the inflation. Then the depreciation 4% and other expenses by 14%. Now this is where the VAT and also the branch expansion. We have added about 6 branches since the first quarter to this quarter. Apart from that, about 3 or 4 relocations. That again, the cost of relocation is similar to opening a new branch. So altogether, I would say around 10 new branches plus relocations. So that's other reason for increase in expenses. Moving on to the balance sheet. 4% increase in balance sheet from December to March, from 334 billion to now we are 347.4 billion. There again, the biggest increase is on the asset side, it's on the loans and advances, 6% growth from 227 billion to 241 billion, 14 billion growth. There again, we were quite focused in ensuring that those loan growth is coming from high margin assets as well as repricing our own book, and in the process some of the low yielding assets by repricing we would have exited from those, and we were working on the margin side. In terms of the liability side, the major increase is on the deposits from 203 billion to 227 billion, 24 billion growth in deposits. This is the breakup of segmental mix of our loan book. Roughly, corporate banking account for 34% of our lending book. Then project financing 23%, and the retail and SME space 40% of the lending book. And then the currency wise, you would see roughly 188 billion in rupees and 59 billion in foreign currency. That's roughly 24% of the lending book is in foreign currency. And over the last 5 years, we have grown our loan book cumulative average growth rate of 20%. But you would see year to date, it's 6%. So if you annualize, it's roughly around 24%. So we are quite keen to continue this growth momentum, and also the currency balance, currency 24% of the foreign currency loans. We are thinking of improving it, reducing the foreign currency exposure and moving towards a more LKR-based balance sheet. Quality of assets, quite a well diversified portfolio as you see from the pie chart. It's quite well spread. The largest exposure of 20% is on trade, which is basically reflecting the economy. and agriculture exposure is 10%, which is in line with the regulatory minimum requirements. Gross NPL ratio stood at 2.87%, which is in line with the industry ratio, and net NPL at 1.56%. So NDB continue to focus on ensuring quality lending book. So we're working on improving these ratios further as we move along. Customer deposits, there again, year to date, 12% growth. On average, we have grown by 20%. So out of that, 179 billion in LKR and 49 billion in foreign currency. As I mentioned earlier, out of this 24 billion impressive growth, roughly 3 billion, actually 3.3 billion, has come from CASA balances, so which is an area that we continue to focus. Though CASA ratio-wise, it's roughly around 21%. You may not see that growth because of the significant growth in overall deposits, but as a quantum, the CASA has grown by 3 billion. And actually, that's an area that we will continue to focus using our branches and trying to reap the benefits of the investments that we have already made on these branches, 106 branches. Capital adequacy ratio-wise, we are quite above the minimum requirements. Bank is quite well capitalized as per current Basel guidelines. And also we are gearing towards Basel III. And from July onwards, total Tier 1 ratio under Pillar 1 is moving up to 7.25, and the total capital adequacy ratio moving up to 11.25. So at the moment, we are quite above that, 9.26 Tier 1 and 12.8% on the Tier 2. But as we go along, as we grow our book, and as Sri Lanka move towards the Basel III, these Tier 1, Tier 2 ratios are moving up, and bank is working on strengthening the capital base to support this growth, as well as to ensure that the minimum capital requirements are maintained. But we want to keep an optimum level of capital rather than going for significant capital infusion to ensure that the return on capital ratios are maintained at industry or above industry level. We are right now a bit low on that, but that's where we are targeting to work on. The investor ratios, of course, the share price has come down from December 156 to 139.6. That as at quarter end. As at now, it's about 143, hovering around 143. Still, it's one of the shares which is marketed below the book value. Book value of our share is 149.3. So roughly slightly below the book value. So that's something that one has to look at, especially the investors. ROE-wise, 14%. ROA has improved from 0.9 to 1.03. Earnings per share from 19 rupees to 21.25 as at quarter end. So this is probably the reflection of the, low share prices reflects the current market trend, but still, I believe there's enough scope for improvement in the share price as it's currently trading below the book value. These are basically the highlights, financial highlights as per the first quarter. And I'm looking forward to your question and answers, your questions. And I have a couple of my colleagues, Head of Vice President Corporate Banking, Boneka, the finance, Suendini. We have VP retail banking, Raj Abubakar, and also VP who's in charge of branch network, Sanjay, and also the finance team. So happy to take on the questions that you may have. You can use the chat option. So, and when you pose a question, we can read the question here, and we can also announce what the question is, and then we can come up with our views and our answers. Yeah, there's one question about number of branches to be open this year. Sanjay, want to comment?
Yeah, we have, as you know, we have already opened 2 branches, and we are looking at opening around 4 more branches during this year. So the focus on branch expansion remains the same. What we want to do is stabilize the existing branches while conservatively expanding the network, and that will be the focus in the future.
There's another question. Apart from the capital ratios, what are the leverage and liquidity ratios that needs to be met by the bank by July 2017?
The bank has to maintain liquidity coverage ratio of minimum of 80% for the year 2017, and we are very much well above the ratio currently. It's around more than 100%, so we are maintaining it. And the other one is the liquidity ratio, which the DBU and FCBU, no change, and we are very well above that. On the leverage ratio also, we are quite confident, and from 1st of July we will be able to maintain the ratio.
Okay. There's another question on loan growth expected this year and next year. I think it's in line with the country's growth rate and also the way that bank is growing. There's another question also. What will be the focus in loan expansion, corporate or SME? So I will answer both questions together. We are roughly around 57% of our book is on corporate and project finance, as you would have seen from the pie charts, whereas the retail and SME 43%. But we would be focusing more on retail and SME space, because with 106 branches, we have to reap the benefits, that we have the reach and there is potential, and we are upskilling the credit skills, and that's actually, of course, as a development financial institution, that's one of the forte where our credit skills are good. So we have to make use of those credit skills, and making use of that, we are actually increasing our exposure to retail and SME, whilst growing our corporate and project finance business. The focus would be more on growing the retail and SME book. So as for the numbers, you would have seen about 6% growth in the first quarter. We would like to continue with a similar momentum in growing our lending book. There's a question, why is your impairment reducing quarter and quarter despite increasing NPA? Bunik, you want to answer that? I think actually we explained, I think the high impairment last year was due to couple of significant accounts. Bunik, you want to explain?
Some customer specific ones that we had, but if you take the entire corporate banking NPL book, currently we have a provision of about between 75 to 80% has been impaired, and with adequate security covering that. And with that, with the impairment being looked on a quarterly basis, and we are quite comfortable that we'll be in a comfortable zone during this year.
Okay, there's a question on how are you planning to improve your fee income? Is it by increasing the fees or expanding range of products? There again, I think that's an area that we are really focused on. We have quite a good corporate banking portfolio and also very good trade finance book. And our fee-based income compared to interest income as a ratio relatively high compared to most of the banks. Because we have a history, we have a good resources and also very good correspondent banking network, which we have invested over years and which is what we have built up over years. So that we will continue to focus on trade side, expanding into even branches. We have in some trade desks. So that's one area that we are focusing on. Other one is on as you move on to a more retail space, naturally with the loans, even the personal loans, there is a fee revenue that is available. Then on a card business, that's again an area where we are growing. Again, there's opportunities to improve on the fee-based income on card business. So there are various areas that we are working on, and also reviewing the fee structure is another area, and also how we apply the fees. So various strategies are there, which we are working on to improve on the fee-based structure. There's another question on what's the loan book split between retail and SME. Roughly around 50-50. Yeah, so it's between retail and SME roughly 50-50. Total 40% of the book is on retail and SME. So of that 50%, so overall 20% of the bank's lending book is on retail, 20% on SME. But both these areas, one of the focus areas to go more on both these aspects. Any comments on the proposed financial transaction levy? You want to comment anything?
I think the industry is waiting more clarity on the details, so we are yet to. At this moment, we cannot comment on it because we need some more clarity on the basis and the method of collecting the financial, whether it's a direct transaction levy or not. We need to wait and see when the act is enacted.
Yeah. There's a question on what is the NIM expectation, what is the expectation on interest rates for the rest of the year? Niran, you want to comment on that? Niran, Vice President of Treasury is there. So what is the NIM expectation? NIM, I can talk about NIM, then thereafter about the interest rate expectation you can share. NIM, of course, there's an improvement to 2.7%, but that's an area where one is the repricing of the book, other one is moving towards more LKR-based lending. As you would have seen, 24% of our book is on foreign currency, so when we move towards more LKR, the margins are higher. And also on moving towards retail and SME space, again the margins are better. Plus reducing the cost side, so a focus on CASA base, focus on growing our current account base, so that we can work on improving on the cost of funds. So it's a two-pronged arrangement. One is improving on the margins, other one is bringing our costs down. So we are expecting this NIM to improve further as we move along. With regard to the interest rate expectations, Niran can add your comments.
With the current successfully government raising these development these sovereign bonds, immediately the pressure on the interest rates in the shorter run also will ease because the liquidity pressure will ease. This has been already taken up in the bond market. If you look at it, it is reflected by the bond yields, long-term bond yields coming down by about 100 to 150 basis points. So there is a very strong possibility with the pressure on the liquidity easing. There is a chance that the interest rates also in the short term also will come down especially in the second half of this year.
That's another question, Niran, on the same side. Given the recent international bond issue, do you expect interest rates to come down in second half? To answer that part.
I think, there's a high probability because already long-term bonds, as I mentioned, has come down drastically and significantly by about 150 basis points.
There's one question again on in growing your loan book, which products are you focusing on? Housing, etc. See, it's actually growth from all fronts. We can't say that any particular area because one is the industry-wide, you would have seen quite a well-spread industry focus. When it comes to product-wise, I think it's all products have equal opportunities to grow. So we have product leaders, and also we have quite a good sales team, plus the branch network. There again, as we mentioned, the credit skills of our branch managers, the credit approval structure is quite impressive. So this is what we want to make use of in growing our lending book. So it's actually a well-spread growth in all products. There's a question with indirect taxes imposed last year. Do you see a slowdown in deposits? Sanjay, you want to comment? I don't think.
Yeah, well, we have not seen that. So if you look at our deposits, it has been there have been a significant growth. So we don't see that hindrance to mobilization.
Okay. Will you opt for a rights issue soon? As we mentioned, we have to raise capital. I mean, the one is to support this growth momentum. Other one is in line with the regulatory requirements, Basel III coming in. So naturally, we are looking at a few options. Rights issue can be one of those. So naturally, we are looking at various options available, and most likely in the second half, we had to approach the market in raising capital. Any other questions? Overall, could you tell us what the strategy for the bank and in what direction you will drive the bank to? Okay. Actually, we are in the process of finalizing our strategic plan for the next 3 to 4 years. We're looking at 2020, T20, and working on our strategic plan. Couple of things that I think I highlighted earlier was one was shifting our focus more towards retail SME. So the balance sheet mix from more corporate project funding based lending to retail SME space. Other one is on our liability side. We are still 108% in terms of advanced deposits, but we want to bring it down so that we are self-financed in terms of deposits. There again, try and get more low-cost deposits in terms of improving our CASA ratio. Then the balance sheet structure. the currency structure from 25% foreign currency to more rupee-based balance sheet structure, working on the margins, on the interest margin, and also on the process improvements. I mean, that's an area where we see there's enough room for NDB to improve. So we have started streamlining the processes, started having a core team to look at what are the process improvements needed, and also some of them may be automation as well. Some of them simplifying the processes and trying to streamline and improve the SLAs. So try and improve the efficiency. Plus, naturally, the strategy would cover the growth in entire asset book. Plus, how we can integrate and get more out from our group investments. As NDB, I mean, we are the only bank with significant investments in investment banking side, wealth management, and also our investment in Bangladesh. So all those investments, try and make more out of those investments in terms of one is the integration, one is getting them to deliver the optimum return on the capital. So with various opportunities, various strategies we are working on, even on the group level. So that all are covered in our strategic plan, which we are planning to finalize within next 1 to 2 months, and thereafter on a strong footing to move forward in terms of growing the bank's balance sheet growth. What is your plan regarding Ceylon Bank shares, as it's a capital inefficient for Basel III? Yes, there is an investment which is held as available for sale category as an investment. So we will look at various strategies. I mean, there are a lot of options. One is to continue this holding. Other one is disposing. Looking at various options at the moment. So it will continue to be reflected in available for sale category for the time being. There's another question on, can you tell us what percentage of your branches are breaking even at the moment? I think it is how it's depending on from bank to bank, how you apportion your cost. I mean, some banks, they apportion their entire head office cost. Some, they won't apportion head office cost. So you can compare break-even number of branches because various banks are applying various mechanism to apply the, calculate the break-even level. But we are working on improving the number of branches. And as you would see, about 35 branches have been added in last 3 years. So naturally, it takes some time for some of those branches to break even. But at the same time, we have seen several branches during latter part of last year and also during this first quarter moving towards actually good profitable status. Now, one good example yesterday, Kota branch opening. We had a very good first day deposit. A lot of clients came in and 100 million. Over 100 million deposits were taken during the first day. So it's a matter of how you market, how you apply the leadership of different branches, and how we have our deposit and lending mix to ensure that each branch is contributing to the bottom line. And that's an area that as a center management team, we continue to focus on in improving all these branches to ensure that all are making sizable profits. And by the way, we have also decided and also already implemented in classifying these branches into super grade branches, category A, category B, kind of based on their balance sheet size and also their profitability. So each branch manager is also have certain targets to achieve, so that he or she can also aspire to be moving towards the next level of the branch category. So that we are looking at various ways of incentivizing and ensuring that the entire branch network contributes its optimum results out of their investment. That's a long question I was reading. On expansion on the retail banking side, what is the balance sheet mix you are pushing towards? And also, if you look at all banks, they say they are going to expand retail and SME. What is it that you are going to do different on this, given your balance sheet size and funding costs relative to other banks? Okay, long question, relevant question. The potential for NDB is in our people, the resources. We have a well-trained, quite a good, well-educated, very skillful staff. And as a development financial institution over the years, credit skills is inbuilt in our culture. And about 10 years back, with the acquisition of ABN AMRO, and with that came corporate banking expertise, and also a very good corporate banking portfolio that we have groomed and grown. And we have I think the entire gamut of very good corporate portfolio under Bhuvneka's team. And trade side, again, thanks to long years of developing our trade book and also correspondent banking relationships, and also some of them coming from ABN AMRO days, we have a very good trade potential. Plus branches, 106 branches located at very good locations, led by a very experienced people, and also led by a very experienced vice president, and also the branch staff are coming from various commercial banks. Some are original NDBers who have been there for many years, plus a mix of those who are joined, high caliber staff who are joined from various other commercial banks. So potential-wise, people's quality-wise, we have all the resources to grow our branch banking, SME, and also the retail space. So if one asks what are we doing differently, I think we don't do different things, but I think we have the caliber, we have the in-house built quality staff, and also capacity to reap the benefit. So which we have not probably done in the past. So that's one area that we are trying to focus and improve and contribute from getting the best out of our existing investments. So that's why, again, unlocking our potential. We have a lot of potential that itself would help us to improve in our move towards more retail and SME space. That seems to be the last question. Yeah. Okay. So it seems to be the last question. So once again, I would like to thank quite a lot of participants here. So I would like to thank all of you for participating and also raising some very good interactive questions. And looking forward to addressing you all in a seminar webinar after we end our next quarter, and hopefully much better results and to continue this growth momentum. So thank you very much. Thanks.